The lights turn on every morning at 7. Climate control systems hum to life 2 hours before that, calibrating temperature and humidity to exact specifications. Staff schedules are posted on the back office wall, carefully organized by department and shift. Cleaning crews move through the corridors with the same practiced efficiency they've maintained for years. Kitchens are stocked, linens are pressed, guest rooms stand ready, each one prepared as though someone might arrive at any moment. The facility is not abandoned, it is not mothballed, it is not waiting for renovation or sale, it is operating. But somewhere in the arithmetic between daily readiness and actual occupancy, between the cost of keeping the doors open and the revenue that walks through them, a question formed that no amount of preparation could answer. If a project can be profitable and still be impossible to keep open, what does profit actually mean? The project didn't fail after losses. It failed while still earning. This distinction matters because it destroys the most common assumption about business failure. Most people believe the sequence is simple. Revenue falls, losses accumulate, cash runs out, and closure follows inevitably. The narrative is clean. The cause is obvious. This project earned money in its final year of operation. Guests paid full price. Services were delivered. Invoices were settled. Revenue appeared on financial statements exactly as projected. By the most basic definition of commercial success, money came in. Yet the facility closed anyway. The reason has nothing to do with demand failure or quality decline. It has everything to do with a more fundamental problem that profit alone cannot solve. Revenue measures only one side of an equation. The other side, the cost of remaining operational at a particular scale, can grow faster than any reasonable income stream can match. Luxury hospitality exists in a specific economic space. It promises experiences that cannot be delivered cheaply. High-end accommodations, exceptional service, pristine maintenance, and exclusive atmosphere all require constant investment. Guests pay premium prices precisely because these elements never falter. But premium prices have ceilings. Markets set limits on what even wealthy customers will pay. Competitors establish benchmarks. Economic conditions influence willingness to spend. A luxury property can charge more than budget alternatives, but it cannot charge infinite amounts. Operating costs, by contrast, face no such natural ceiling. Labor expenses rise with wage inflation and benefit requirements. Utilities track energy markets. Maintenance expands as facilities age. Insurance premiums reflect risk assessment and litigation trends. Regulatory compliance demands add layers of expense that cannot be negotiated away. Scale amplifies this asymmetry. A small luxury property with 20 rooms can adjust staffing, reduce hours, or temporarily close sections during slow periods. A large facility with hundreds of rooms and extensive common areas cannot downshift without fundamentally altering what it offers. The project in question was large enough that its fixed costs created a baseline expense that operated independently of occupancy. The building needed heating regardless of how many guests slept in it. Security had to cover the entire perimeter every night. Common areas required maintenance whether 10 people used them or 100. This created a threshold. Below a certain level of consistent occupancy, revenue could not cover the minimum cost of remaining open. Above that threshold, the facility generated positive cash flow and could sustain itself. The threshold was not impossibly high, but it was inflexible. For several years, the project stayed above the line. Occupancy held steady. Seasonal patterns were predictable. Revenue exceeded expenses by comfortable margins. Financial statements showed profitability. Owners, operators, and investors had every reason to believe the model worked. The collapse, when it came, was not a dramatic plunge. It was a slow drift below the threshold, followed by months of attempting to return to viability. followed by the recognition that the mathematics had become insurmountable. Profit, in those final months, was still present. But profit was no longer enough. The gap between revenue and the cost structure required to generate that revenue had narrowed to the point where any additional pressure, any unexpected expense, any small decline in occupancy, would tip the balance into operational impossibility. Closing the facility was not a response to losses. It was a response to the realization that continuing to operate, even profitably, was consuming resources faster than those resources could be replaced. The project worked, the numbers looked positive, demand existed, revenue arrived, and yet it still collapsed. Success wasn't defined by guests, it was defined by spreadsheets. Every luxury property serves multiple constituencies simultaneously, but their priorities rarely align. Guests evaluate success through experience, the quality of service, the comfort of accommodations, the seamlessness of operations. Staff measure it through stability. Consistent hours, fair wages, manageable workloads. The local community judges it by economic impact, employment numbers, tax revenue, supplier relationships. None of these groups controlled the definition that ultimately mattered. Owners and investors measured success through financial metrics that existed entirely independent of operational quality. Return on investment, cash flow, debt service coverage, asset appreciation. These numbers determined whether the project continued or closed, regardless of how well it functioned for everyone else. The ownership structure shaped everything. This was not a single wealthy individual running a passion project. It was a complex arrangement involving multiple investors, institutional capital, management contracts, and financial instruments designed to distribute both risk and return across various parties. Each party had different expectations and different timelines. Equity investors expected returns that justified their capital allocation. They had alternative investment options, each with projected returns. The luxury property needed to perform competitively, or capital would flow elsewhere. Debt holders expected regular payments regardless of operational challenges. Loans were structured around projected cash flows. Missing payments triggered default provisions. Refinancing required demonstrating continued viability. Management companies operated under contracts that aligned their compensation with revenue and profitability metrics. They made operational decisions, but within financial parameters set by ownership agreements. These incentive structures created a reporting apparatus that translated operational reality into financial language. Daily, managers reviewed occupancy rates, average daily rates, revenue per available room, and operating expense ratios. Weekly, they compiled department-level financial performance. Monthly, they produced complete profit and loss statements for ownership review. The facility could be fully booked with delighted guests while simultaneously failing to meet financial targets. The experience could be flawless while the numbers deteriorated. Success for guests and success for investors operated on different measurement systems. The reporting structure also created information asymmetries. Guests saw the finished product, polished surfaces, attentive service, seamless operations. They had no visibility into the cost structure that produced these outcomes. Investors saw financial statements that aggregated operational reality into line items: labor costs, facilities expense, administrative overhead. They had limited visibility into the daily operational decisions that produced these numbers. Management sat between these worlds, translating operational needs into financial requests and financial constraints into operational adjustments. Their job was to maintain the guest experience while meeting the financial targets that ownership demanded. For several years, this worked. The facility operated profitably. Guests were satisfied. Investors received acceptable returns. Management maintained equilibrium between experience quality and cost control. The problem emerged when the financial targets became impossible to meet without compromising the operational standards that defined the product. Management could reduce labor costs, but only by cutting service levels. They could defer maintenance, but only by risking facility degradation. They could increase prices, but only within limits set by market competition. Every adjustment created trade-offs. Every trade-off moved the project incrementally away from the model that had attracted guests in the first place. Ownership saw numbers falling short of projections and demanded corrections. Management implemented adjustments that preserved financial performance in the short term, while slowly eroding the foundation that made long-term viability possible. The guests, for a while, noticed nothing. Service remained excellent. Facilities stayed immaculate. The experience continued unchanged. But the financial structure beneath that experience was shifting. The margin between revenue and expense was narrowing. The flexibility to absorb unexpected costs was disappearing. The buffer that allowed management to invest in maintaining standards was depleting. Success, as ownership defined it, was becoming incompatible with success as operations required it. The project could satisfy one constituency or the other, but not both simultaneously. When forced to choose, the financial definition won. It always does. Guests can love a property. Staff can dedicate themselves to excellence. The community can depend on the economic activity. But if the spreadsheet shows insufficient return, the project closes. Not all profit is the same. This mattered. Financial statements presented a single number labeled net profit, but that figure concealed crucial distinctions about where profit came from and what it could actually accomplish. Gross profit measured revenue minus direct costs of service delivery. The wages of staff who served guests, the food and beverages consumed, the linens laundered, the utilities consumed during occupied periods. This number indicated whether the core business model worked. If a property couldn't generate positive gross profit, the fundamental value proposition was broken. This project consistently generated positive gross profit. Every guest who stayed contributed margin above the direct cost of serving them. The pricing worked. The service delivery was efficient. At the transaction level, money was made. Operating profit measured gross profit minus the fixed costs of keeping the facility operational. Management salaries, year-round maintenance staff, property insurance, baseline utilities for unoccupied spaces, marketing, and administrative overhead. This number indicated whether the facility could sustain itself at its current scale. Here, the picture complicated. Operating profit existed, but it was thin. The fixed costs of maintaining a large luxury property consumed most of the gross margin that guests generated. Seasonal variation created periods of strong operating profit during peak months and periods of operating loss during slow months. Across a full year, operating profit was positive, but the margin was insufficient to provide meaningful financial cushion. Net profit measured operating profit minus capital costs, debt service, ownership returns, capital improvement reserves, and long-term maintenance requirements. This was the number that appeared on financial statements and determined whether investors considered the project successful. Net profit was technically positive in several of the project's final years. The facility earned more than it spent, including debt payments. By conventional accounting standards, it was profitable. But the nature of that profit revealed the problem. Net profit existed only because certain essential expenditures were being deferred. Capital improvement reserves, which should have been funded annually to maintain the facility's long-term condition, were chronically underfunded. Maintenance was performed reactively rather than preventively. Equipment was repaired rather than replaced. Systems were kept running past their optimal lifespan. These deferrals preserved short-term profit while accumulating long-term obligations. Each year of underinvestment added to a growing backlog of necessary work that would eventually demand attention. The profit also depended on specific conditions remaining stable, labor costs staying within projected ranges, occupancy maintaining historical patterns, no major equipment failures, no regulatory changes requiring expensive compliance updates, no market disruptions affecting the customer base. Any deviation from these assumptions would convert thin profit into loss. The profit was real, but it was fragile. It existed within a narrow band of conditions and depended on continued deferral of obligations that couldn't be postponed indefinitely. Most importantly, the profit was insufficient for its intended purpose. Investors expected returns that compensated them for risk and opportunity cost. The profit generated fell short of these expectations. It was positive, but not positive enough to justify continued capital allocation to this project, rather than alternatives. Management understood this distinction. They produced financial statements showing profit while simultaneously warning that the profit was structurally inadequate. They explained that short-term positive results masked deteriorating fundamentals. Ownership initially dismissed these warnings. Profit was profit. The project was working. But profit that exists by deferring essential investment is not the same as profit that funds growth and resilience. One is sustainable. The other is borrowed time. This project was profitable on borrowed time, and the bill was coming due. Every dollar earned arrived already assigned. Revenue appeared as a single line on financial statements, suggesting flexibility and possibility. In reality, that money was spoken for before guests ever arrived. Labor costs claimed the first portion. Wages, benefits, payroll taxes, workers' compensation insurance, and training expenses consumed approximately 45% of revenue. This ratio was consistent with luxury hospitality industry standards, but it represented an inflexible obligation. Staff couldn't be reduced proportionally with occupancy. A facility with 100 rooms needed most of the same positions whether 50 rooms were occupied or 90. Front desk coverage had to extend across all hours guests might check in. Housekeeping had to be available for all occupied rooms. Maintenance had to monitor the entire physical plant. Security had to cover the full perimeter. Utilities and operational expenses took another 15%. Heating, cooling, lighting, water, waste management, and communication systems all operated on schedules determined by facility needs rather than occupancy levels. Empty rooms still needed climate control to prevent damage. Common areas still required full illumination for safety. Systems still ran continuously because shutting them down and restarting created greater expense and risk than maintaining steady operation. Property maintenance consumed 12%. This included routine cleaning, landscaping, minor repairs, pest control, and seasonal upkeep. A large facility in a climate with distinct seasons faced relentless maintenance, pressure. Paint faded. Roofs leaked. HVAC systems required servicing. Plumbing developed issues. None of this paused during slow periods. Administrative overhead, marketing, and reservation systems claimed another 10%. Management salaries, accounting services, legal fees, insurance, technology subscriptions, and marketing expenses all continued regardless of occupancy. Maintaining visibility in the luxury hospitality market required constant investment in digital presence, industry relationships, and brand positioning. Debt service absorbed another 12% of revenue. The loans that financed construction and subsequent improvements demanded regular payments. These obligations were completely independent of operational performance. The bank didn't reduce the payment when occupancy fell. This accounted for 94% of revenue before any consideration of capital reserves, owner returns, or unexpected expenses. The remaining 6% represented the entire margin available for everything else: equipment replacement, emergency repairs, revenue fluctuations, market downturns, or any other deviation from plan. 6% is not a cushion, it's a vulnerability. The revenue stream itself was unpredictable in ways that made planning difficult. Luxury hospitality demand concentrates in specific periods. Peak season might run 12 to 16 weeks, during which the facility operated near capacity and could command premium pricing. Shoulder season offered moderate occupancy at reduced rates. Off-season brought periods of low occupancy where revenue barely covered variable costs. The facility needed peak season revenue to subsidize the rest of the year. But peak season performance depended on factors beyond management control: weather, economic conditions, travel trends, competitor actions, and broader consumer confidence. A weak peak season couldn't be compensated by improving off-season performance. The market simply didn't support high occupancy during those periods. Management could offer discounts to attract guests, but discounting eroded the already thin margins that made operation viable. The cash flow pattern created constant pressure. Revenue arrived unevenly throughout the year, but expenses occurred consistently. Large payroll obligations hit every 2 weeks. Loan payments came due monthly. Major maintenance projects couldn't wait for convenient timing. Management maintained lines of credit to smooth these timing mismatches, but credit had costs. Interest accumulated. Credit capacity was finite. Lenders wanted to see improving trends, not declining occupancy and thinning margins. Every month, revenue flowed in and immediately flowed out to meet existing obligations. The money never accumulated. It never created a buffer. It never provided the breathing room that would allow management to make strategic investments or weather unexpected challenges. The revenue was there. The facility was earning. But the money couldn't breathe. It arrived already committed, already spoken for, already insufficient to meet all the demands placed upon it. This is how a profitable facility operates in crisis. Not because money isn't coming in, but because the money that comes in can't cover everything that needs covering while also building toward future stability. The arithmetic was clear. Revenue needed to grow, or expenses needed to fall. Neither proved possible within the constraints the project faced. The size that created revenue also multiplied obligation. A small luxury property operates with flexibility that large facilities cannot match. 20 rooms can be staffed with a lean team that adjusts to occupancy. Common areas can be modest. Mechanical systems can be right-sized. The entire operation can scale up and down within reasonable ranges. This project was built large. The exact room count doesn't matter. What matters is that the facility crossed the threshold where size transformed from an asset into a liability. Large scale creates impression. Expansive lobbies, multiple dining venues, extensive recreational facilities, and carefully landscaped grounds all contribute to the luxury experience guests expect. The scale itself communicates exclusivity and investment. It signals that the property deserves premium pricing. But scale also creates fixed costs that operate independently of revenue. A large lobby needs climate control and lighting, whether 2 guests pass through it or 200. Multiple dining venues require equipment, licenses, and inspection compliance, whether they serve 50 meals or 500. Extensive grounds need maintenance crews year-round, regardless of how many guests walk the paths. The facility had been designed during a period when projections showed sustained high occupancy. The architects and developers envisioned full utilization of all spaces. Every amenity would attract guests. Every venue would generate revenue. The scale would be justified by demand. Those projections proved optimistic. Peak performance was achievable during specific periods, but sustained year-round high occupancy never materialized. The facility regularly operated at 60 to 70% of capacity, which sounds reasonable until you understand the cost structure. At 60% occupancy, all the fixed costs of 100% capacity remained. The entire building needed heating. All public spaces required staffing. The full security perimeter demanded coverage. Insurance costs didn't decrease because rooms sat empty. Property taxes didn't decline because revenue underperformed. The revenue from 60% occupancy had to cover the costs built for 100% operation. The mathematics didn't work. Management explored partial closure strategies. Could certain wings be mothballed during slow periods? Could some amenities close seasonally? Could staffing be concentrated in specific areas while others went dark? Each option created problems. Closing wings meant guests might encounter locked doors and unavailable spaces, undermining the luxury experience. Seasonal amenity closures confused marketing messages and disappointed guests who expected full access. Concentrated operations made the facility feel empty and diminished, precisely the opposite of the abundant experience luxury hospitality promises. The brand positioning compounded the problem. Luxury properties compete partly on comprehensiveness. Guests expect everything to be available, always. Expectations include full-service dining at multiple venues, 24-hour room service, concierge available around the clock, recreational facilities accessible whenever guests want them, and spa services bookable with minimal notice. Meeting these expectations at a large facility required maintaining staff and systems in ready state continuously. The property couldn't function as a luxury destination while operating with obvious cutbacks and limitations. Scale had created a ratchet. The facility could expand to meet peak demand, but it couldn't contract to match low-season reality without fundamentally changing what it offered. Some costs could flex slightly with occupancy. Housekeeping hours could be reduced when fewer rooms needed cleaning. Food and beverage costs tracked consumption. Certain utilities showed modest variation with usage levels, but the overwhelming majority of costs were fixed by the decision to operate at this scale. That decision had been made during development, locked in by construction choices and brand positioning. Reversing it would require reconceiving the entire property. The trap was complete. The scale attracted the investment necessary to build something impressive. The impressiveness justified premium pricing. The premium pricing generated revenue. But the revenue couldn't cover the costs that the scale created unless occupancy remained consistently high. And occupancy didn't remain consistently high. The facility earned money while slowly drowning under the weight of its own size. Every month that operated below the break-even threshold consumed capital. Every season that underperformed projections deepened the hole. The project was profitable in aggregate, but the profit was insufficient to offset the periods of loss that the scale made inevitable. Size, which was supposed to be the competitive advantage, had become the structural flaw that no amount of operational excellence could overcome. Rooms were filled, just not often enough. The fundamental equation of hospitality is deceptively simple. Occupancy multiplied by average rate equals revenue. Raise either variable and revenue increases. The solution to financial pressure appears obvious. Fill more rooms or charge more per room. This project achieved respectable occupancy. Annual averages hovered around 65%, which placed the facility above many competitors. Management took justifiable pride in maintaining these levels through seasonal fluctuations and market volatility. 65% sounds sustainable. It represents 2/3 utilization, leaving reasonable capacity for peak periods while avoiding the revenue disaster of chronic vacancy. Industry consultants often cite 60 to 70% as a healthy operating range for luxury properties. The problem was threshold economics. The facility didn't need 65% occupancy, it needed 85%. This wasn't arbitrary. The cost structure, locked in by scale and service standards, required a specific revenue level to break even. Calculating backward from required revenue through average rates yielded the necessary occupancy. 85%, sustained throughout the year. Seasonal analysis made the challenge clearer. Peak season occupancy routinely exceeded 95%. The facility turned away business during these periods, constrained only by physical capacity. This Performance suggested strong market positioning and effective operations. Off-season occupancy dropped to 35%. Shoulder seasons achieved 60%. Averaging these figures across the full year produced the 65% annual result. But averages concealed the structural problem. The facility couldn't shut down during off-season. All the fixed costs continued. Security, insurance, maintenance, core staffing, utilities, debt service. None of these paused while occupancy plummeted. The peak season revenue, substantial as it was, had to subsidize 9 months of underperformance. The calculation was straightforward. Peak season generated enough profit to cover its own costs, plus build a surplus. The surplus had to be large enough to offset off-season losses and shoulder season thin margins. It wasn't large enough. Management implemented numerous strategies to improve occupancy. Targeted marketing campaigns for shoulder seasons highlighted different aspects of the experience. Special event programming attempted to create demand during traditionally slow periods. Corporate partnership programs sought group business that could fill rooms midweek. Pricing optimization adjusted rates dynamically to maximize revenue per available room. Each initiative generated modest improvements. Occupancy increased by a few percentage points. Revenue showed incremental gains, but the fundamental gap remained. The facility needed dramatically higher off-season occupancy or substantially higher rates during peak season to reach the threshold where operation became financially sustainable. Market research explained the constraint. The luxury hospitality market in this location was fundamentally seasonal. Weather, local events, and cultural patterns concentrated demand into specific periods. Off-season visitation was limited not by lack of awareness or poor marketing, but by basic customer preference. People simply didn't want to visit during those months. Raising rates faced similar limitations. The facility already commanded premium pricing. Pushing rates higher risked pricing out the customer base without attracting a higher-tier segment. Luxury hospitality has elasticity. Above certain price points, demand drops sharply as customers choose alternative destinations or defer travel entirely. The facility tested rate increases during peak season when demand appeared inelastic. Occupancy declined marginally but noticeably. The revenue gained from higher rates was partially offset by the revenue lost from lower occupancy. The net effect was slight improvement that still left the facility far below the required threshold. The mathematics became a prison. The facility needed impossible occupancy levels to sustain its cost structure, but the market couldn't provide those levels. The cost structure couldn't be reduced without fundamentally changing the product that attracted guests in the first place. Occupancy of 65% represented solid performance in a competitive market. It demonstrated operational competence and market acceptance. It generated substantial revenue. But it wasn't enough. The distance between achieved performance and required performance appeared small in percentage terms, but was vast in financial impact. The gap represented millions in annual shortfall, accumulating month after month into an insurmountable deficit. The facility was full enough to generate profit. It wasn't full enough to survive. The project couldn't downshift. Every business faces pressure to reduce costs during difficult periods. The standard playbook includes familiar moves: reduce staff, defer maintenance, renegotiate contracts, cut discretionary spending, and streamline operations. These adjustments preserve cash and maintain viability until conditions improve. Management attempted all of these. Staff reductions eliminated positions during slow seasons. Maintenance schedules were lengthened. Service contracts were renegotiated for better terms. Marketing budgets were cut. Discretionary improvements were postponed indefinitely. The savings were real but insufficient. Even after aggressive cost reduction, monthly operating expenses remained within 10% of peak period levels. The facility couldn't achieve the dramatic expense reduction that would make low occupancy periods financially sustainable. The reason was structural. Certain costs at a luxury facility are non-negotiable. Staffing couldn't fall below minimum safe operations levels. Front desk needed coverage 24 hours. Security required multiple personnel on site at all times. Maintenance had to respond to emergencies immediately. Management needed to oversee operations continuously. The skeleton crew that represented absolute minimum operation still consumed substantial payroll. Reducing staff below this level would require closing the facility entirely. There was no intermediate state of barely open that made economic sense. Utilities followed similar logic. A large building in a climate with temperature extremes needed climate control year-round to prevent damage. Pipes had to be kept from freezing. Humidity had to be controlled to protect finishes. Air circulation had to continue to prevent mold. The building couldn't be shut down without risking expensive damage that would cost more to repair than the utility savings captured. Insurance costs were fixed by contract and calculated based on property value and risk profile, not occupancy levels. The facility was insured for the same amount whether empty or full. Property taxes operated identically. Assessment values didn't adjust for operational challenges. Debt service was completely inflexible. The loan agreements specified payment amounts and schedules. These obligations continued regardless of revenue performance. Default triggered serious consequences, including potential foreclosure. Maintenance presented the most dangerous trade-off. Deferred maintenance saves money immediately, but accumulates problems that become more expensive over time. Equipment that receives inadequate service fails prematurely. Buildings that lack proper upkeep deteriorate faster. Small issues that are ignored become major repairs. Management understood this dynamic but faced impossible choices. Current cash flow pressures demanded immediate expense reduction. Long-term facility health required sustained investment. The two imperatives conflicted directly. The deferred maintenance approach bought time but guaranteed future crisis. Every system that was serviced less frequently than recommended moved closer to failure. Every repair that was postponed until absolutely necessary became more extensive when finally addressed. The building was aging faster than it should, accumulating a maintenance backlog that would eventually demand resolution. The cost structure also faced external pressures that management couldn't control. Labor costs rose with minimum wage increases and regional wage inflation. Healthcare benefit costs escalated annually. Utility rates increased with energy market trends. Insurance premiums climbed as carriers reassessed risk. Regulatory requirements added compliance costs that couldn't be avoided. Each of these pressures was modest individually. Collectively, they created steady upward pressure on the cost baseline. The facility's expenses in its final year exceeded opening year costs by 35%. Even after adjusting for inflation and accounting for service reductions. Revenue over the same period had grown by 18%. The gap was widening. Costs were rising faster than revenue could match. The luxury product required sustained investment that the revenue stream couldn't support. Management was caught between the need to maintain standards that justified premium pricing and the financial pressure to reduce costs that maintaining those standards demanded. Cutting costs meant degrading the experience. Degrading the experience meant losing the market positioning that enabled premium pricing. Losing premium pricing meant revenue would fall further below the cost threshold. The facility was trapped in a dynamic where the solutions that would improve short-term finances would destroy long-term viability. Operating costs couldn't come down enough to match available revenue. The project couldn't operate sustainably at its current scale and service level. Something had to give. Eventually, what gave was the decision to remain open. Saving money meant destroying the product. The facility's market positioning rested on comprehensive luxury. Guests paid premium rates because every element of the experience met elevated standards. Service was attentive, Facilities were immaculate. Amenities were abundant. The property delivered on the promise that everything would be exceptional. This positioning wasn't arbitrary. The luxury hospitality market divides into distinct tiers based on service levels and pricing. Upper-tier properties command rates 2 to 3 times higher than mid-tier competitors by delivering meaningfully superior experiences. The differential isn't subtle. Luxury guests notice details: thread count in linens, response time to requests, knowledge level of staff, quality of ingredients in meals, condition of fixtures, and availability of services. These guests have traveled extensively and understand what premium pricing should deliver. The facility competed in this upper tier. Its rates reflected this positioning. Its marketing emphasized comprehensive excellence. Guest expectations were calibrated accordingly. Cost reduction threatened every element that justified premium pricing. Staff reductions meant slower service. Slower service created guest frustration. Frustrated guests left negative reviews. Negative reviews damaged reputation. Damaged reputation reduced booking rates and put downward pressure on pricing. Deferred maintenance created visible deterioration. Luxury guests immediately notice carpet wear, fixture tarnish, landscape decline, and equipment that doesn't function properly. Each visible deficiency undermined the perception of excellence that premium pricing required. Amenity cuts eliminated competitive advantages. If the spa reduced hours, the facility could no longer market itself as a full-service wellness destination. If the restaurant limited its menu, food quality claims became less credible. Each service reduction moved the property incrementally toward mid-tier positioning. The problem was that mid-tier positioning didn't support the cost structure. Even aggressive expense reduction couldn't bring operating costs down to levels that mid-tier pricing could sustain. The facility's scale and debt burden required premium revenue, but premium revenue required premium service. Premium service required costs that the revenue couldn't cover. Management understood they were managing decline. Each cost reduction preserved short-term viability while undermining long-term competitiveness. Each compromise with service standards eroded the foundation that future recovery would require. Some advocated for radical cost reduction. Strip the operation to minimal basics, accept mid-tier positioning, reduce rates to fill rooms. Perhaps volume could compensate for lower margins. Financial modeling killed this approach. Even with occupancy at 90%, mid-tier rates couldn't cover the facility's fixed costs. The debt alone consumed more than mid-tier properties, typically allocated to all expenses combined. The building was simply too expensive to operate as anything other than premium luxury. Others argued for doubling down on excellence, invest in improvements, elevate service standards even higher, command ultra-premium pricing from a smaller but wealthier customer base. This required capital the project didn't have. Banks wouldn't lend more money to a struggling property. Investors wouldn't inject additional equity into an operation showing declining performance. The cash flow required to fund improvements didn't exist. The facility was caught between incompatible requirements. It needed to reduce costs to survive financially. It needed to maintain costs to preserve the product that justified its revenue. No middle path existed. Luxury hospitality allows little margin for error. Guests who pay premium prices expect perfection. They compare experiences across properties worldwide. They have options. Disappointed guests don't return. They don't recommend. They don't forgive. The facility had built its reputation over years of consistent excellence. That reputation was fragile. A few seasons of declining standards could destroy what a decade of investment had created. Management faced the choice clearly: reduce costs and watch the facility slide toward mid-tier irrelevance that its cost structure couldn't survive. Maintain standards and watch cash reserves deplete until closure became inevitable. Neither path led to sustainability. The model was broken at its foundation. The costs required to deliver the product exceeded what the market would pay for that product at any achievable occupancy level. Saving money meant destroying what guests paid for, not destroying it immediately, but beginning a process of degradation that would eliminate the competitive positioning that made the facility viable. The luxury business model is unforgiving. Either execute at the highest level and command premium pricing, or fail to compete effectively at any level. This project could no longer execute at the highest level within its financial constraints. Once that became clear, the outcome was determined. The only question was timing. Eventually, revenue stopped being a buffer. For several years, positive cash flow provided protection. The facility earned more than it spent each month. These modest surpluses accumulated into reserves that could absorb unexpected expenses or seasonal shortfalls. Management maintained a cushion that allowed them to address problems without immediate crisis. The cushion depleted gradually. Each off-season consumed reserves, each emergency repair drained cash. Each period of below-target occupancy took its toll. The protection diminished month by month. Then came the inflection point. A winter heating system failure required emergency replacement of major equipment. The repair cost exceeded 6 months of accumulated surplus. Cash reserves dropped to levels that created vendor payment delays. Suppliers began requiring advance payment. Credit lines reached their limits. The facility remained technically profitable. Monthly financial statements showed positive net income. But the profit wasn't generating cash fast enough to rebuild depleted reserves while meeting accelerating obligations. This is the paradox of financial collapse. A business can show profit on accounting statements while simultaneously running out of cash to meet payroll and vendor payments. The timing mismatch between revenue collection and expense obligations creates gaps that destroy otherwise viable operations. The facility's revenue arrived unevenly. Large group bookings paid deposits months in advance, but those deposits were restricted funds that couldn't be used for general operations until the actual stay occurred. Individual reservations often were charged at checkout, meaning revenue lagged service delivery by weeks. Credit card processing took days to settle. The cash arrived, but not immediately when needed. Expenses, by contrast, couldn't wait. Payroll was due bi-weekly regardless of cash position. Utilities disconnected service for non-payment. Suppliers stopped delivering when accounts went past due. The debt service payment arrived monthly like clockwork. Management began managing cash flow hour by hour. Which payments could be delayed? Which vendors would tolerate late payment? Could payroll be split into 2 distributions to smooth cash requirements? Could the debt service payment be delayed a week without triggering default provisions? These decisions consumed leadership attention that should have been focused on operations and guest experience. The general manager spent mornings reviewing cash position and planning payment timing instead of reviewing service standards and guest satisfaction. The facility was profitable but illiquid. This distinction would have been academic except for its practical implications. Profitable businesses can survive low liquidity temporarily if they can access credit or if they trust future revenue will resolve current gaps. Profitable businesses with depleted reserves and maxed credit lines cannot. Every month brought the same hope. This month's revenue would exceed this month's expenses by enough to start rebuilding reserves. Every month brought the same disappointment. Unexpected costs consumed the surplus. Progress was impossible. The facility was maintaining operation but not building toward stability. Profit had become meaningless. The accounting statement showed positive numbers. The bank account showed insufficient cash to meet next week's obligations. The gap between these realities was growing. Investors recognized the pattern. Profitable operations that can't generate sufficient cash to meet obligations aren't sustainable. The profit number was technically accurate, but strategically irrelevant. What mattered was whether the business could continue operating tomorrow, next week, next month. The answer became increasingly uncertain. Management requested additional capital injections from ownership. The proposal was logical. A modest cash infusion would stabilize operations, fund necessary improvements, and provide runway to implement revenue growth strategies. The return on this investment would be substantial if it enabled the facility to reach sustainable occupancy levels. Ownership declined. Their analysis showed that the capital required to truly stabilize operations exceeded what they were willing to commit to a property with deteriorating fundamentals. Small infusions would simply delay the inevitable without changing the underlying economics. This was the moment profit stopped protecting the facility. The financial statement still showed positive results, but those results no longer convinced anyone that the operation had a viable future. Profit without liquidity is vulnerability. Profit without cash reserves is fragility. Profit without investor confidence is isolation. The project had all three problems simultaneously. The solution accelerated the collapse. Management proposed a straightforward remedy: increase room rates 10%. The first season showed encouraging results with revenue per occupied room rising as projected. Then booking data revealed the problem. Advance reservations declined. Conversion rates dropped. The facility captured more revenue from each guest, but attracted fewer guests overall. Demand elasticity had been misjudged. When rates increased while competitors held steady, guests shifted reservations. The facility's product was excellent but not meaningfully superior to alternatives. At previous pricing, it represented good value. At increased pricing, it became expensive. Higher rates meant fewer bookings. Fewer bookings meant lower occupancy. Lower occupancy meant operating further below the threshold where fixed costs could be covered. Revenue gained from higher rates was offset by revenue lost from declining occupancy. Price increases also eliminated crucial group and corporate business. When the property exceeded corporate travel policy limits, multi-year contracts went to competitors. Group business provided crucial shoulder season revenue precisely when the facility most needed it. Management eventually restored previous pricing. But guests, lost to competitors, didn't immediately return. Market perception didn't reset instantly. The facility operated in the worst possible position: premium costs, mid-premium pricing, and below-target occupancy. Selling required admitting something was wrong. The ownership group faced a problem with no good solutions. The facility was consuming capital and showing declining performance. The rational response was to sell and redeploy capital elsewhere. The market for distressed luxury properties is thin. Offers came in substantially below the ownership group's basis in the property. Accepting these offers would mean recognizing massive losses. Sale would also be public acknowledgement of failure. For institutional investors, this admission had implications beyond one property. Investment committees would question judgment. Industry reputations would suffer. The incentive was to delay. Perhaps market conditions would improve. Perhaps a turnaround strategy would gain traction. But delay consumed additional capital. Every month of operation below break-even required cash infusions. Every season of disappointing performance reduced the asset's value. The ownership structure created complications. Multiple parties with different priorities couldn't agree on strategy. Some wanted to sell immediately. Others wanted to invest more and attempt turnaround. Still others wanted to wind down operations and liquidate assets. Management operated in this vacuum. Without clear direction, they made incremental decisions that kept operations running but didn't address fundamental problems. The facility continued operating not because anyone believed the situation was salvageable, but because no one could agree on the alternative. When the facility finally shut down, it wasn't the result of strategic choice. It was the result of running out of options as cash reserves depleted to levels where operation became literally impossible. Accounting shifted from growth to damage control. Financial reporting exists to inform decision-making. At this facility, it became an exercise in justification. Management knew the numbers were bad. Ownership knew the numbers were bad, but acknowledging failure directly would force decisions no one wanted to make. Monthly reports emphasized positive variances. Revenue came in 2% above a lowered forecast. Expense reductions saved more than targeted. Each statement highlighted accomplishments while soft-pedaling deterioration. Forecasts were revised downward to create achievable targets. Management successfully delivered results in line with revised projections, while actual performance declined steadily. Accounting classifications shifted to improve optics. One-time expenses were isolated as non-recurring. Necessary maintenance was capitalized rather than expensed. These weren't fraudulent manipulations. Every adjustment was legally permissible. But the cumulative effect was financial statements that obscured rather than illuminated the facility's condition. Debt covenants created additional pressure. Loan agreements required maintaining specific financial ratios. Management managed earnings to stay just above covenant triggers, timing expenses to fall in quarters where revenue was strong. The transformation of accounting from information to defense marked organizational decline. When numbers exist to support decisions, they reflect reality. When numbers exist to avoid decisions, they reflect hope and spin. The facility's financial reports in its final years were technically accurate, professionally prepared, and substantially misleading. They showed profit while the business consumed cash. They demonstrated stability while fundamentals deteriorated. New management inherited the same math. Ownership believed a change in management might reverse declining performance. The search began. Proposals arrived from hospitality management companies specializing in luxury properties. Ownership selected a firm with extensive luxury hospitality experience. The transition occurred over several months. New management arrived, conducted assessment, and implemented their systems. Initial results appeared promising. Guest satisfaction scores increased. Service consistency improved. Several operational inefficiencies were corrected. But financial performance didn't fundamentally change. Revenue increased modestly, expenses declined slightly. The net effect was marginal improvement that left the facility still operating well below the threshold required for sustainability. The problem wasn't execution. The problem was mathematics. New management faced the same cost structure that defeated their predecessors. The building required the same heating. The debt demanded the same payments. The competitive market imposed the same pricing constraints. The operators recognized this reality quickly. Within 6 months, they were reporting the same concerns. Cost structure unsustainable, occupancy insufficient, capital improvements needed but unaffordable, long-term viability questionable. The new operators stayed for 18 months. They improved many aspects of the operation, but they couldn't make the numbers work. When their management contract came up for renewal, both sides agreed not to extend. New operators couldn't fix it because it wasn't an operational problem. It was a structural problem. You can't operate your way out of mathematics that don't work. The project wasn't closed, it was bleeding. The facility maintained full operations through its final season. Rooms were available for booking. Staff reported for shifts. Services were delivered. From guests' perspective, nothing indicated crisis. Behind the scenes, the situation was deteriorating rapidly. Vendor payments were delayed routinely. Some suppliers stopped delivering until past due balances were settled. Payroll was met every cycle, but just barely. Credit lines were maxed, cash reserves were depleted. Management was managing crisis daily rather than operations. Each morning brought the same question. Do we have enough cash to get through this week? Staff sensed the instability. Key employees began exploring other opportunities. Turnover increased. Service quality degraded subtly through slower response times, less thorough room preparation, and minor service failures that accumulated into a diminished guest experience. The market was also noticing. Competitors observed the facility's struggles. Industry contacts shared information about financial difficulties. Declining reputation made new bookings harder to secure. Reduced revenue deepened financial stress. Management tried to project normalcy. Marketing continued. Social media maintained cheerful content. The facade was maintained for guests and the public, but industry insiders, creditors, and employees all knew the truth. The facility was operating unsustainably, consuming capital it couldn't replace, and approaching the point where continuing would become impossible. The decision to close, when it finally came, was almost anticlimactic. Cash reserves hit a threshold where the next month's obligations couldn't be met. The project had been unsustainable while appearing functional. Open doors and operating systems created the illusion of success. The numbers told the real story. This wasn't rare. It was predictable. The luxury hospitality industry sees this pattern repeatedly. Properties open with impressive funding, strong market positioning, and professional management. They operate for years, generating revenue and serving guests. Then they close, not because of scandal or catastrophe, but because the economics quietly stopped working. The similarities across cases are striking. Large-scale facilities with high fixed costs, seasonal demand patterns creating occupancy challenges, debt structures requiring consistent cash flow, service standards demanding sustained investment, cost pressures increasing faster than revenue can match. Ownership typically cycles through the same stages: initial confidence that professional management will optimize performance, growing concern as results miss projections, replacement of management in hope that new leadership will unlock value, eventual recognition that the problem is structural rather than operational. The financial patterns are equally consistent. Years of reported profitability while cash reserves quietly deplete. Increasing reliance on credit to smooth timing mismatches. Deferred maintenance that saves cash short-term while building long-term obligations. Eventually, a triggering event forces recognition that the operation isn't viable. Yet despite these repeated patterns, new luxury projects continue to launch with similar characteristics. The cycle repeats because decision-makers believe their situation is different. Better location, better design, better management, better timing. Sometimes they're right. Some luxury properties do achieve sustainable economics, but many don't. This project wasn't unusual in failing. It was unusual only in failing while profitable. Most distressed properties show losses before closure. This one demonstrated that profit itself isn't protection when underlying economics are fundamentally broken. The project worked, just not at its own scale. Everything about the facility functioned as designed. The architecture was sound. The location was attractive. The services were professional. The operation functioned. At a smaller scale, this project would have succeeded. 20 rooms instead of 200. Modest common areas instead of expansive. Right-sized staff instead of the army required to maintain a palace. The economics would have worked. But the project wasn't built at that scale. It was built large, for reasons that made sense during development, but created unsustainable economics during operation. The size was meant to impress, to establish market presence, to capture economies of scale. Each objective was rational. Collectively, they created a facility that couldn't support its own cost structure. This is the core tragedy. The concept was sound. The execution was competent. The market was real. The demand existed. The product was excellent. But the scale was wrong. And once built at that scale, the project couldn't adjust. The profit the project generated in its final years represented operational success. Management did their jobs well. Staff delivered quality service. Marketing attracted guests. But operational success couldn't overcome structural failure. The profit existed within a cost structure that made that level of profit insufficient. More profit was needed. The market wouldn't provide it at achievable occupancy levels. The gap was unbridgeable. The closure didn't occur because of mismanagement, fraud, or lack of effort. It occurred because the mathematics were wrong from the beginning. The project needed economics that the market couldn't provide at the scale that was built. The final insight is uncomfortable. Profit didn't save this project because profit isn't always enough. A business needs profit appropriate to its structure, adequate to its obligations, sufficient to build resilience. This facility generated profit, just not enough profit. The gap between what it earned and what it needed was small in percentage terms, but fatal in practice. Some projects don't fail because they lose money. They fail because the money they make isn't enough to hold them together. This was one of those projects.